Hello everyone, welcome to Educate 247. This is the 10th lecture on our special revision series for SEBI Grade A 2020 examinations. In this lecture, we will be discussing MCQs on AS2 inventory. Accounting standards are a part of your syllabus for commerce and accountancy for SEBI Grade A. We have already prepared videos on Accounting Standard 1 and the numerical part of Accounting Standard 2. You can go through those videos to understand what kind of questions will be asked in the exams. Now let's begin with the question. Number 1. Inventory does not include A. Materials used in the production of goods to be sold. B. Assets intended to be sold in the normal course of business. C. Equipment used in the manufacturing process. Or D. Assets currently in the production for normal sales. So the answer to this question is equipment used in the manufacturing process. Now to understand the answer, we have to first understand what inventories are. The inventories can be defined as assets held, number 1, for sale in the ordinary course of business, that is finished goods. Number 2, in the process of production for sales, that is work in progress. And number 3, in the form of material or supplies and is to be used in the production process or the rendering of services. Example, raw material. So inventories consist of finished goods, work in progress and raw materials. However, inventories do not include spare parts, servicing equipments and standby equipments which can be used only in connection with an item of fixed asset and whose use is expected to be irregular. So inventories do not include equipments. Hence we come to the answer that equipment used in the manufacturing process does not form part of the inventory. Such machinery and spares are generally accounted for as fixed assets. So equipments are a part of fixed assets and not a part of inventory. Now to question number 2. Inventories should be generally valued at A. Cost, B. Net realizable value, C. Lower of cost or net realizable value, or D. Higher of cost or net realizable value. So the answer to this question is lower of cost or net realizable value. As per the accounting standard, inventories need to be valued at lower of cost, which is basically the price paid for the purchases, the cost of conversion, and other direct costs incurred in bringing the inventories to their present condition and location. The cost should also include the duties and taxes. However, trade discount, rebates, and duty drawbacks are deducted in determining the cost of purchase. So cost also includes duties and taxes, but trade discounts, rebates and duty drawbacks, they do not form part of the cost. So now we've understood what cost is. So let us look at what net realizable value is. Net realizable value or NRV, which is determined based on the estimated selling price less estimated cost of completion and the estimated cost necessary to make the sale. So net realizable value is nothing but the selling price minus estimated cost of completion minus estimated cost necessary to make the sale. Now NRV is the assessment of NRV is required to be made at each balance sheet date. So we have to determine NRV at each balance sheet date. Then we compare the cost and net realizable value, and whichever is lower, the inventory is valued at that value. Hence your answer is lower of cost or net realizable value. Educate offers various courses for SEBI Grade A examinations. We have comprehensive course for SEBI Grade A 2020 examinations, which covers syllabus of both paper 1 and 2. We also have MCQ courses for SEBI Grade A 2020 paper 2, and we also have SEBI Grade A 2020 crash course for phase 1 and 2. you can apply with coupon code SEBI, SEBI and get discounts on comprehensive courses and crash courses. However, since MCQ courses are already at a discounted price, no further discount is available in this course. You can enroll on these various courses on the basis of in which stage of preparation you are. On to question number 3. Net purchases equal invoice amount and A. Plus freight in plus discounts, B. Less purchase returns plus purchase allowances, C. Plus freight in less purchase discounts, or D. Plus discounts less purchase returns. Now, to understand the answer to this question, we have to first understand what net purchases include. So as already discussed, the cost of inventory comprises of the price paid for the purchases or the cost price, the cost of conversion and other direct costs incurred to bring the inventory to its present condition and location. So the cost price consists of so the inventory comprises of the cost price, the cost of conversion, and other direct costs incurred to bring the inventory. Now the cost price further includes A. Purchase price excluding trade discounts and rebates. So the cost price also includes the purchase price. However, trade discounts and rebates do not form part of the cost, so they have to be deducted. B. Duties and taxes paid on the purchase of goods. So cost price, it includes duties and taxes, but however, those that are refundable, but the duties that are refundable in nature, they shall be excluded. Number C. Freight inwards or carriage inwards, both primary, that is cost incurred on bringing the goods to the factory of the company, and secondary, that is cost incurred on transporting the goods to the warehouse, are to be included. So freight inwards and carriage inwards both form part of the cost. And D. Any other expense that can be directly attributable to the purchase. So now we've understood what cost includes and what it does not include, right? So now let's go to our option once again. Option A, plus freight in plus discount. See, plus freight in is correct because freight in, it forms part of the cost. However, discounts do not form part of the cost. So plus discount is incorrect here. It should have been less discount. So option A is incorrect. Option B, less purchase returns. Less purchase returns is correct because purchase returns, they do not form part of purchase. However, plus purchase allowances is incorrect here. Purchase allowances are a kind of discount only, and since discount do not form part of the cost, purchase allowance also do not form part of the cost. Hence, plus purchase allowance is incorrect here, which makes option B also incorrect. Option C, plus freight in less purchase discount. So option C is the correct answer here because freight in forms part of the cost and purchase discounts do not form part of the cost. Option D, plus discount. So plus discount is incorrect here because discount does not form part of the cost. So our answer is plus freight in less purchase discounts. Question number 4. Accounting standards do not permit following method of inventory valuation. A. FIFO method, B. LIFO method, C. Weighted average method, or D. None of the above. So our answer is option B. LIFO. Now let us look at the 3 most popular methods of inventory valuation. They are your first in first out method, weighted average method, and last in first out method. Let's look at FIFO method first. According to this method, the inventory items are sold in the same order in which they are purchased or manufactured. The oldest inventory products are sold first as per FIFO method. So in FIFO method, whichever inventory is purchased first is also sold first. That's why we get the name first in, first out. Now, weighted average method. In this method, inventory and cost of goods sold are calculated based on the average cost of all items purchased during a period. This method is mainly used by businesses that don't have variation in the inventory. So in average method, it does not matter which item is purchased first and which item is purchased second, because in this method an average price of all the prices is determined and that average price is used in valuating inventory. And this method is used by businesses that have homogeneous product, that means which do not have variation in their inventory. Now coming to the third method, last in first out method. So LIFO method is just the opposite of FIFO method. In FIFO method, the inventories that are purchased first are sold first, right? But in LIFO method, the inventories that are purchased last are sold first. This inventory valuation method is based on irrational assumption that most recently purchased or manufacturing items are sold first. Now, since this method is irrational, businesses do not use this method. Hence, accounting standards do not permit the use of LIFO method. Accounting standards permit the use of FIFO method and weighted average method only. Last question, question number 5. Inventory is disclosed in the financial statements under A. Fixed assets, B. Current assets, C. Current liabilities, or D. Intangible assets. So the answer to your question is current assets. Inventories are disclosed as current assets in the balance sheet as they are realizable within 12 months. So those assets that are realizable within 12 months, they form a part of your current assets, and those assets that are realizable after 12 months, they are your long-term assets. Now let us look at the other disclosure requirements for AS2 inventory in the balance sheet. The following disclosures need to be made in the financial statements. First, the accounting policy adopted by the company in the inventory measurement. So what policy you are adopting, that you have to disclose. Second, the basis of costing, that is FIFO or weighted average, should be disclosed. Third, the classification of inventory into finished goods, raw materials, work in progress, and stores and spares, etc. So we've already understood that inventory comprises of finished goods, raw materials, work in progress, etc., etc., right? So all those classifications, they need to be shown in your balance sheet. Carrying amount of inventories carried at fair value less sale cost. So carrying amount also has to be disclosed. Then the amount of inventories recognized as expense during the period. So the inventories that are sold during the period also have to be disclosed in the balance sheet. And lastly, any inventory amount written down and recognized as expense and its subsequent reversal, if any. So these are the disclosure requirements regarding AS2 accounting for inventories. So we've come to the end of the video. If you found the video useful, then do like and share the video, and subscribe to the channel for more videos on different topics of accounting standards and other topics of SEBI Grade A 2020 examinations. Thank you.